hidden cost of low delta trading. What gives, in other words?
Why not? Isn't this free money?
Might think so. Yes. Never know. All right. With big moves becoming the norm, some may ask, why not just sell further out of the money premium where the strikes almost never get tested?
It's so far out of the money. Why not just hold it?
Keyword, almost.
Almost.
But even if they don't get tested, there are some other implications, which we'll cover today. Yes. We received a query from a customer inquiring whether employing a low delta strategy involves any hidden costs. Today, we'll show you these strategies and strangles and how they can actually have much more risk than is seen on the surface. Just filled in my lean hog short. Got out for $140.
Nice.
Lovely.
Love the ding.
Love the ding. Let's check it out. Next slide, please. Let's take a look at the study. SPY 2015 to present, so 10 years of data. Sold separately and managed at 21 days. The 25 delta, 16 delta, and 5 delta strangles. So just looking at the distance from the current market price with different implied volatility levels, et cetera, et cetera. So using delta will account for changes in implied volatility. High IV will get us further away. Low IV will get us closer to the market price. Compared the average P&L as a percent of credit received before and after some outlier moves like the 2020 to COVID and in 2025. Single worst loss also compared as a multiple of credit received. So that's typically how we look at it with short premium trades. When you are selling something, the average P&L as a percentage of credit received is a good way to look at it. And then if you're stopping losses or looking at your average loss relative to credit received, that's pretty much the best way to consider it as well, because if you're trading different products outside of SPY, using that as a multiple will help you adjust for IV relative to stock price, etc. So what do we got? What do we got?
Oh,
before
you gotta hold up. You got one more.
Before we look at the results, the general problem with super low delta strangles stem from the super low credits you collect relative to the outliers. One outlier move for a 5 delta strangle could take multiple years to recover and skew the average expectation of the strategy for decades.
And this is a big point because you look at the probability of profit or the pop on the platform and it says 95 or 97. And it looks like free money. And a lot of the time, it is free money, right? You sell those puts or those strangles and there's no risk that is realized and you move on. It's the outlier risk that really comes into play. And the other problem is that most people up the size of those trades.
Of course.
So, you look at it and you're like, oh, this is a 95% pop. Instead of doing my normal trade size of 10K, I'm going to do 50K. Yeah. And that's where you run into issues because if you do hit those, handful of times where you have outlier risk and you're 5 or 6x your normal size, now you got some issues.
Yeah. And as we've seen this year, and as we saw in 2024, and as we saw in 2023, and 2022, and 2021, there's always going to be big moves in the market. The market could be up 10, 20% on average over the last couple of years. But if you look within those years, there are certainly big moves to the downside and upside. So it's definitely got to account for that.
And it's not always price movement. It's not always the crash price. Volatility changes, like that is another issue that you can run into with these sort of trades.
Yeah, but we've got some distinct takeaways that we can give at the end of this study here. So excluding the big moves in the past 10 years, the 5 delta strangle actually had the largest P&L as a percentage of credit received because it wasn't tested as often as the others, which makes all the sense in the world. Yeah. But when you include the outliers, which you should always do, into the 10-year data set, that drops the average P&L from 33% to only 5% of credit received, while others increased as the delta increases. So we get the question of, why 1/3 the width with defined risk spreads? Why 1 standard deviation or 20 delta or 30 delta for undefined risk? And it's because of this. It's because when you have strategies that are closer to the price and you're picking up more premium, when everything's going right, you're making multiples of your 5 delta strategies. And when everything's going wrong, you're in a similar boat.
or less. I mean,
less.
even less here. And
Yeah.
and that's, you can even multiply that, because if you're trading those 5 deltas, a lot of people up the size. And so not only are you like the amount of realized risk that you have with those 5 delta options is so much greater than those closer at the money options. And that's a function of the credit, size of the position. You can't be picking up the pennies in front of the steamroller.
Yep.
You get tripped one time.
Yep. And that's why the average P&L as a percentage of credit with all of this data is highest with the 25 delta, even though the average P&L as a percentage of credit, excluding it, is the lowest.
Mm-hmm.
And it's because over time, you pick up so much premium and your winners offset your losers by that much more.
Yeah.
And the worst losses multiple of credit is lower, because if you think about like selling an at-the-money option for $500, what has to happen for you to lose a 3x, 4x, 5x on that position? It has to go deep in the money, and literally the stock has to move multiples of a situation where you're selling a 16 delta or 5 delta where you're collecting a lower credit. What has to happen for, especially a 5 delta, what else to happen for you to realize or see a 5x loss on that 5 delta? That option doesn't even have to be in the money. That option could move from a 5 delta to a 25 delta, and you are seeing a 5x loss.
Yeah.
So that's the big difference.
And that's changes in buying power too.
Yeah.
The position gets bigger.
Totally.
And I think it's, just looking at excluding outliers is like, something you can't do in practice. This is like the absolute best case scenario.
Correct.
Line where, it's just not going to happen.
Since the outliers on a 5 delta strangle tend to be so much more severe as a multiple of credit than higher delta strangles, because again, you don't even need the product to move in the money if you're looking at it prior to expiration. Each dollar in credit you receive could be exposed to more than twice the outlier risk than each dollar in credit of a larger delta strangle. And again, if you're thinking of credit received relative to seeing multiples of that credit received as a loss, you are certainly moving in the money on a 25 delta or closer option, where with a 5 delta, you don't even have to be close to money.
The change in vol might be even bigger than
and that's really the biggest problem, I think, or the problem you can run into.
Especially when vol's low, which is most of the time.
Yep. All right, final slide here. Takeaway: smaller delta strangles carry a much higher pop, but they are prone to more outlier risk as multiples of how much premium they carry. So right now, if you're looking at a 5 delta strangle and SPY, trading for around $2, 25 delta strangle, 6 times that amount. If you wanted to trade 6 of those 5 delta strangles to get the same premium, you are actually carrying more than twice the total outlier risk than just selling 1 strangle, but you're also carrying 6 times the delta exposure. So if there is that big move, like the tariff stuff that happened, the Japanese yen unwind are the 2 that I can think of most recently. COVID, you're going from a 100 delta position to a 600 delta position.
Yeah.
Even though starting out, it's the same. Now, we're seeing a lot of questions in the YouTube chat, like, what if you roll? What if you just close it out and move it to a different cycle? Like, that's totally fine. But the big key here is, if you're doing the low delta strangles and you want to do that as a conservative way to bring in capital, you need to still be trading small to where if and when you see the 20% rip or sell off against you, you don't have to exit for a multiple of loss. You can just hold it or roll it. The problem is when you're doing 6x the amount because you think it's never going to get tested and then it does, and now you're forced to close an option that's still out of the money because you can't handle the buying power of it.
Yeah.
That's the big problem.
And it's even worse because volatility explodes. This option is priced way higher relative to when you originally put it on just on volatility alone. Not even including the delta. I saw somebody mention the 111 trade. That's exactly what happened. Was in August people were doing this the long put spread and then selling the tails, and they were doing tails in size. And you get this move where you're kind of even playing for that move, but the volatility explosion, squeezes you out of these positions because you're just too big. So it always comes back down to size. Like if you want to sell these 5 delta strangles, you're going to have a lot of winning trades. But if you start upping the contracts, that's where you really put yourself in a pickle.
Yeah. You have to be able to hold the positions that you have
Yes.
on through any volatility environment. And if you were trading through the tariff stuff and you got out of it, then I think you're okay. But if you were forced to close positions that weren't even in the money, then you're trading too large, because you can't be closing options that are out of the money still, especially if it's because the buying power is too large and you were forced to close it.
Yeah.
Rather than, if you're stopping losses at 1 or 3x or 2 or 3x credit received, totally fine if you're redeploying. But if you're closing because you can't hold it because of buying power expansion, that's when the sizing is a little off.
Great job from the team.
Yes.
2 good research segments today. This
Love
is
to
a good
see it.
one. And of course, the diagonal spread one that was tailored just to us. Beautiful. Good stuff.